What's up, everyone? We're back. Welcome back. It's been a minute since I've done a TTO. Been working, grinding, and I'd like to do these when I'm inspired to have these conversations with people. And last time I brought CJ on, he absolutely slayed it. You guys were going wild in the chat. You guys kept telling me to bring him on. You guys were asking questions. Well, if we have enough time, we will get kind of back to some of the topics we had last week. But CJ has been dropping epic threads on Twitter, which I think everyone should be following. You guys should be following what he's saying on Twitter. I think he's dropping a lot of nuggets. And so I wanted to bring him on and talk about all this stuff right now in as simplest terms as possible so that we can understand what the hell is actually going on in the world. So without further ado, and without, dragging on this monologue, CJ, how are you doing, brother? Good to have you. It's been a minute. And last time you came on, we were kind of joking that you were hitting the nail on the head. And I think we're at that moment again where you're just dropping too much wisdom. And it happens like, I don't know. I saw some threads and it'll happen like a week later. And I do have them up here, so we'll talk about them. But CJ, how you doing, brother?
I'm doing good. Thanks for having me back on. It's an honor to be here. And if this were ever the time to ring the warning bell, right now is it.
Awesome. Okay, well, let me just pull some of these threads up so we can basically get into them, and we will use them as jump off points. So first thread, actually, before we go in, like I was saying before the show, and I was telling everyone right now, maybe we got to break down some of these topics like as simple as possible. So first and foremost, we are going to be talking about interest rates. We are going to be talking about the bond market. We might even get into stable coins if we don't go too long. So maybe here's the first thread. This is pinned on your Twitter, guys. And also go follow him, CJ Constantinos on Twitter. Highly recommend you guys follow him. But here's the first one. And oddly enough, before you posted this, it seemed like, oh, maybe CJ's just talking randomly out of thin air. And I do have the receipts of Jay Powell saying this exact thing. So maybe first and foremost, let's cover this thread for the people and then, give them some definitions, and then maybe we'll bring up Jay Powell.
Awesome. Yeah. So actually, this is the tweet that Max Keiser quoted and was actually cited in a Forbes article talking about the debt spiral. So what's happening here is I just wanted to draw a simple line of what the conclusion of what the Fed is doing right now. Because even today, you heard the governors come out and a couple of presidents come out and say, what's happening is that rates are going to stay higher for longer, because their idea is that higher rates is going to fight off inflation. And without going into too much detail, let me say it this way. They would be correct if, and here's the big if the United States wasn't $36 trillion in debt, or I think it's 34, it's getting up there pretty close. It's growing fast. It's hard to keep track of. It's growing so fast, but we're $34 trillion in debt. We have $211 trillion of unfunded liabilities, which means that we have a problem because we're not earning money. You and I, we go to work, we earn money, and then we spend less money than we earn. And whatever's left over, we can save or we can invest depending on what the marketplace is incentivizing us to do. Well, the government doesn't work that way. They collect roughly $4 trillion in taxes, and then they claim to be spending $6 or $7 trillion. We're finding out now it's probably closer to $8 and $9 trillion that they're spending. So we're running what's called a budget deficit. We're spending more money than we're earning. And that creates a debt problem. And that's why we have the big debt and the unfunded liabilities. But here's the real issue. In order to continue to fund those liabilities, or in other words, in order for people to still receive their Social Security, in order for people to still receive different government benefits and programs and payouts, that money needs to be borrowed. And when they borrow that money at a higher interest rate, that raises the deficit. And that the raising of the deficit requires more borrowing, which is issuing of more treasuries, which forces the yields higher. And you get stuck in this kind of cycle where you can't really escape it. And that's what my tweets have been about. And I think people are really starting to wake up to it. And that's why we see the $27 trillion bond market with more volatility than the stock market, more volatility than Bitcoin. How's that possible? I thought Bitcoin was dangerous because it's volatile. The bond market is supposed to be the most stable market in the world, and it's become the most volatile market in the world. And the reason is because the government is stuck in a situation where they're spending more money than they're collecting. And that's the dilution of the dollar. That is a definition of inflation. They're collecting the dollars, they're borrowing the dollars, and they're spending them into circulation. And that increases the overall amount of circulating dollars in the country and in the world even. And that creates the inflation. And this kind of death spiral, the debt spiral is what Forbes called it, is almost impossible to escape. And that's what some of my newer tweets were about, where right now in a traditional market, like think about it like this. We're all lenders, right? So when we go to the bank, we actually don't deposit our money with them. We lend our money to them. And that's why they pay us interest. Now, what the bank did was they took the money that we gave them and they went and they bought a corresponding asset on their balance sheet. So they don't just take our dollar and hold it. They take that dollar and they invest it. And the goal is to generate a yield with that investment that's larger than the amount of interest they promised to pay us for the original deposit lending. And they arbitrage, I call it custodial arbitrage. They arbitrage the difference between what they have to pay to their depositors and what they can earn in yield in the background. Well, when the Federal Reserve lowered rates in 2008 all the way down to zero, something happened. The banks had to, in order to earn interest, go out the yield curve. They had to go to the longer expirations. They couldn't just buy the 3-month or the 6-month or the 2-year. They had to move out the yield curve in order to actually make a profit. So they've got bumped out into the note and to the bonds. And remember, there's 3 types of treasuries. You have a treasury bill, which expires in less than a year. You have a treasury note, which is 2 to 10 years. And you have a bond, which is 20 plus. So they got pushed out from the bills, which had the least amount of duration, time duration risk, all the way out to the end of the curve into the bonds. And they had to, because the Fed stated the front end of the curve down to zero. So if their depositors, if you remember, at one point when your money in the bank, it would get 0.1% or 0.01%. Why? Well, because the banks were having a hard time getting anything at all. So they can't pay you more than they're making. They'll go out of business. And that process of getting pushed out the yield curve is why they got stuck, because now when the Fed had to raise interest rates to fight inflation, it diluted the value of the collateral. And the collateral was the government debt that was supposed to be producing the yield, which was producing the profit, because the yield was greater than the amount of profit sharing they were doing with their depositors. That whole system is breaking down right now. And I said that when I was back on your show back in March. These guys are breaking the system by raising interest rates because they're devaluing the collateral of the system. When they raise the interest rate, the yield goes up, but the price goes down. So, for anybody who borrows against Bitcoin, if let's just say Bitcoin was worth $100,000 and you borrow $70,000 against it. Well, if the price of Bitcoin goes down, the leverage of your position increases, the loan to value percentage increases. And if it goes down from 100,000 to 70,000, the person who is holding that collateral is going to say, well, I don't trust CJ to pay me back $70,000. I have to sell. I have to liquidate that $70,000 of Bitcoin in order to make sure that I don't lose money on this transaction, because he came to me with $70,000. He hasn't paid it back to me yet, but now the value of this collateral is $70,000. I better sell it and lock in my $70,000 and make sure I don't lose any money here. Well, that's not a situation that you really want to be in as a borrower or a lender, because there's liquidation risk and you might not recover the full $70,000. There's exchange fees. There might be some slippage in there with a bigger position. So you could actually end up losing money. The treasury collateral is losing value every time they raise the interest rates. Of course, we all know they did the most aggressive interest rate hike in the recorded history. The amount of percentage of growth in the rate is unmatched through previous raises. and they devalued the collateral just as fast as they raised the interest rates. And kind of just to tie this back into Bitcoin, I want people to think of, because remember last time I was here, I said Bitcoin is transforming from digital gold to digital collateral. Well, look, Treasury collateral did so well as collateral because the Fed forced rates to stay even. So the principal value of that collateral stayed pretty steady. But over time, it's now deteriorating. And that's because of the amount of inflation that they created through deficit spending. But imagine Bitcoin as the world's most pristine form of collateral, the reserve asset of the internet economy, a deflationary money that gains value over time. They had to state the rate of bonds and treasuries lower so that the value would stay stable so that it could support the system. And Bitcoin would actually be a collateral where you can't state the rate because it's an open free market. Matter of fact, it's the only free market interest rate in the world. Every single country, every single leader, every single central bank, they try to state the price of money. Only in the internet economy is the interest rate based on the supply of money and the demand for loans. When the supply of money is high and the demand for loans is low, interest rates go down. When the supply of money is low and demand for loans are high, interest rates go up. It's a free market price discovery mechanism, the same way it really should work in the traditional system, but it doesn't. And that's an advantage for Bitcoin. So not only do we have free market price of money or free market interest rates and free market price discovery, we also have a new collateral, the most pristine form of collateral in the world that's deflationary and gains value over time. That way, over time, as it's acting as collateral, the amount of leverage actually decreases. If you're borrowing against it, your loan to value goes down. You're more safe, right? Just like if they stated treasury rates from today from 5.25 to 5.5 target all the way down to 0, well, then the market price value of the collateral will go back up. It would actually make the system more stable and more secure. Of course, there's trade-offs with that because when rates go down, helicopter money, funny money, lots of extra borrowing is going to take place. And all of that information is really wrapped up into that tweet. The process of the marketplace incentives, the value of the collateral, the rate at which the collateral is being devalued through this interest rate hiking process that we're going through right now. All of that comes together and creates the debt death spiral. And we're stuck in it right now. There is nothing that the Federal Reserve can actually do. And that was one of my most recent tweets. When you read my tweet, you have to come to one of two conclusions. One, I'm a complete idiot and I have no idea what I'm talking about. Or two, you better listen to what this person's saying because something's happening right now that's never happened before in the history of finance. And unfortunately, I wish I was an idiot, but I'm not. And we are seeing, for the first time in the history of finance, the sovereign debt market exploding because of those levels of debt. You would think if the Federal Reserve could raise interest rates and attract more people to borrow treasuries, then that would be the natural process of attracting demand. But what the smarter market is figuring out, what the smart money, dumb money is buying bonds right now. Dumb money is betting on TLT. I'm sure you have the tweet, Opti, but 21 billion in 2023 alone going into BlackRock's TLT, long dated treasury fund. Everybody and their mother, it's like the common trade, right? It's like when Bitcoin was $69,000, $70,000, you go to the grocery store and someone's like, "Hey, have you heard about Bitcoin?" It's like, whoa, maybe I should think about selling a little bit here, buying some real world assets, because who knows what's going to happen when everybody's talking about it, right? But then after the FTX crash, you're telling people, "Hey, it's a great time to buy some Bitcoin here." They're laughing at you. So the mainstream sentiment is usually off. Mainstream sentiment is wrong. And right there on that chart, that is what the mainstream is hoping and praying for. The mainstream is hoping and praying that we get some kind of head and shoulder design here where the yields bounce back up a little bit, but ultimately they break this trend. You see this trend that we have here going all the way since back May? This is very aggressive selling. This might look like price is going up, but this isn't price. This is actually yield. So it's inverse. The price is going down. These are the yields going up. Everybody hopes that these yields break this trend and come back down to 4% and then break down even lower. And the reason is because they're the ones who are buying the notes and the bonds. This is actually the 10-year, so this would be a note. They're the ones buying it, piling in, hoping that they're going to get a capital gain. But what they don't realize is as they pile into this, they're actually just looking at the face value of the opportunity, which is, hey, it's 4%, it's 5%, I can't go wrong. But you have to be able to sit here and say, I can't take this at face value. If my bank is offering me a CD at 5.25%, or I have an investment opportunity at 6% or 7%, you have to calculate the real rate of return, the real rate of return. And before I dive into real rate of return, let me just address this chart one more time, because I find it extremely interesting that we had these big buyers step in. And if you update this chart today, there was a little bit of a bounce, but we're still above that 4 or 5 level. But you'll notice the candles, they were about to cross that yellow line. Well, that yellow line is the 2-year note yield. So the 10-year and the 2-year were about to uninvert. And the green line is the 3-month bill. That's the shortest duration available to the public. You'd have to have a master account with the Fed to access the repo market, or give your money to a money market fund in order to get a better deal than the 3-month. It's the best short-term duration with the lowest inflation risk because of the time frame. We know we'll get paid back our money in 3 months, and we think we're going to be able to buy this with it. But what about in 10 years? You know you're going to get your money back, but you don't know what the hell you're going to be able to buy. That's the real risk. It's the inflation risk. And if these yields uninverted, then the historical, what they call normalization, because let's just think about it for a second. Like if I said, hey, Opti, I want to borrow, $1 million from you, and I want to borrow it for 3 months. Then you would say, okay, yeah, it's cool. You can borrow it for 5%. I think that's good. I trust you as a counterparty, and I know you're good for it. Let's do it. But what if I said, hey, Opti, I want to borrow for 10 years? Well, would you raise the interest rate or would you lower the interest rate? Obviously, you would raise the interest rate because there's more risk. So in a normal yield curve, the shorter the duration of the loan, the lower the interest rate. The longer the duration of the loan, the higher the interest rate. That's the natural way that these things work. It's called a term premium. Well, what happens when the yield curve becomes inverted and the short-term rates are higher than the long-term rates? There's really only one way to justify this. And the justification by the marketplace is this. We think that there's going to be a huge deflationary event. And because there's going to be a huge deflationary event, the Federal Reserve is going to have to lower the interest rate. And when they lower the interest rate, not only will I get a capital gain, but, and these guys are the real doomsdayers, right? I'm looking toward to a Bitcoin future, to a truth money future. These guys want a depression. They want a recession because they want prices to crash so that they can turn their bonds and lock in that capital gain and then buy real world assets. So they're kind of hoping against everybody just so that they can get a little bit more. But the reality of it is that the only reason, if you're managing a large amount of money and you're trying to protect that money, the only reason that you would buy a 10-year note for less than a 3-month bill, right? Because you could just get the 5.5 at 3 months. Who the hell is buying 10 years at less than 5.5 when you can get 3 months at 5.5? Because the 3-month you can roll. So the 10 years is saying, I want to lock this rate in because I think the rates are going down. What does that mean? When you simplify this down to the core of it, what it truly means is the market believes the Federal Reserve's 2% inflation target, because that's how you calculate the real rate of return. The real rate of return is not the nominal number that you see on the screen. The real rate of return for the 3-month bill is not 5.5%. The real rate is 5.5% minus the inflation rate. That's your real rate of return. That's going to tell you how much your purchasing power has increased, right? Because if you're earning 5.5%, but prices are increasing by 2%, well, then you only earn 3.5%. So the real rate of return is what creates marketplace incentives, not the nominal rate. So in order for the nominal rate to be lower on the 10-year versus the 3-month, that person or that manager has to be thinking in their mind, I want to lock in this rate because I believe the Federal Reserve is at 2%. And because the Federal Reserve is at 2%, and they're going to maintain their target because they have control of the marketplace. They have control of inflation. They're going to get it back down to 2% and they're going to keep it there. Well, then at 4%, I have a 2% real rate of return. Year over year, I'm going to grow my purchasing power by 2%. This is a fantastic deal. I'd love to lock that in for 10 years. The problem is that this is why I call it financial COVID. Because if you look back towards COVID, now in hindsight, we can look back and be like, holy crap, we locked down everything for the flu. Somehow in 2019, a lot of people had flu, some people died. In 2020, a lot of people had flu, some people died. 2020, 21, nobody had the flu because everybody got COVID, right? So when we look back at the data, we're like, wait a second, that data doesn't quite make that much sense. So what really happened here? Well, the result of that was people lost trust in the medical field. People wanted to switch doctors. People wanted a different opinion. The level of trust in the medical field diminished because of the way the data was botched through that whole process. Well, that's what's happening right now in finance. In finance, the data is being botched. I don't really care if it's happening on purpose or if it's happening by accident. It doesn't matter. The data is wrong. So what we have to do is we have to identify the correct data. And in order to do that, thankfully, we still have access to this data. The data is free and abundant, but the proper analysis is scarce and costly. So what we need to do is we need to take a step back and say, how do I determine what inflation is? Well, the real rate of inflation is up for debate. But if you sit down on your personal balance sheet and you look at your expenses compared to your living standards and your quality of life and how you like to spend and consume, well, then what that means is that you can sit down and calculate a number. Now, if you sit down and you take the time to calculate that number, I guarantee you it's not 3.7%. It's not. And it's definitely not 2%. But the people who are buying the 10-year, they think it's going to be 2%. They think the Fed is going to get that rate back down to 2%. They can't get that rate back down to 2%. That's why the yield started shooting off. The smarter money started realizing, oh my gosh, it's not 2%. It can't be 2%. It's 3%. It's 4%. It's 5%. And that's what the real risk is here. You saw a couple of the Fed presidents speak today. One of them came out and said, we have to try to figure out what's causing the long end of the curve to go up. We just don't understand. Why don't people trust us? We know exactly what we're saying. We know what the 2% target is. We know we're going to achieve that target no matter what. Why is the long end of the curve going up? Well, the long end of the curve, the notes and the bonds are going up because the smart money is saying, yeah, I'm going to call your bluff on that. I'm not being compensated enough. 3.5% for 10 years is not enough. Sell. And then the way that they get incentivized to buy again is when the yield goes up, right? So if you understand that process, there's one conclusion that you have to come to. And this is the most important thing I'll say all night. The Fed has lost the natural ability to attract demand by raising interest rates. Because if they raise interest rates, sure, the nominal yield is going to go up. But actually, because of the way the system works and because of the $34 trillion of debt plus $211 trillion of unfunded liabilities plus the ongoing deficit budget, the higher the interest rate goes, the larger the deficit. The larger the deficit, the more they need to borrow. The more they need to borrow, the faster the dollar gets inflated or devalued. The faster the dollar gets devalued, the faster the real yield drops, right? Because real yield is the nominal number minus the percent inflation. So if they're printing money to pay the yield, and then the real inflation rate is just say 5% for sake of math. It's higher than that, but just say right now it's 5%. Then you would take the 5% that you're getting, or the 4.5% that you're getting in the 10-year, and you would subtract the 5%. Well, that's negative, right? If you subtract 2%, you got positive yield. You're growing your purchasing power. But when you use real inflation, what happens is you figure out that the yield is negative. The real yield is negative. And the higher they raise the rate, the more inflation they cause. The more inflation they cause, the higher they have to raise the rate to get people to buy the debt. But the higher they raise the rate, the more inflation they cause. That's the debt circle. And we are stuck in it right now. And it's most evident by the fact that the Federal Reserve cannot raise rates without causing more inflation. Therefore, they cannot raise rates to attract smart buyers because the nominal rate goes up. But the higher the nominal rate goes up, the lower the real yield goes down. They have lost control of the yield curve, and we need to be paying attention.
Wow. Absolutely incredible. And I had a mental picture here, like just a thermostat, like when they raise the rates, the inflation is going up with it. And for a time, it seemed like they could, control that mechanism. But now any little twist of the dial, it's like, oh shit, we have broken this. And CJ, before you go on, guys, if you think CJ is just like some random guy on Twitter that, what you said at the beginning, I'm either some idiot or I know what I'm talking about. Well, it's not just CJ saying this. We have a video here of Jay Powell saying the same thing. So it's short, and then we'll let CJ chime in on this as well afterwards. So listen to this, guys.
Perhaps the most important thing is that these higher treasury yields are showing through to higher borrowing costs for households and businesses, and those higher costs are going to weigh on economic activity to the extent this tightening persists. Perhaps the most important...
Oh, man. Oh, man.
That's a Freudian slip right there. Isn't it funny how he mentioned it for businesses and families, but he completely just didn't say anything about the government? Well, the government is borrowing more than all the businesses and families. It's a multi-trillion-dollar deficit. And if if the higher yields are coming through as higher costs for businesses and families, well, come on, guys, it's obvious. The higher costs are coming through to the federal government. And we know that because if you look at the interest rate expense, I believe in my tweet, we were still under $1 trillion, but I just saw a tweet from James Lavish, which was absolute fire, that had the interest rate expense now officially over $1 trillion. So we now pay more on our interest. In other words, the deficit becomes larger as a result of our interest payment than it does because of our military spending. So we spend more on the military than the whole world combined, much more. But now we spend more on our interest rate expense. There it is right there. We just broke $1 trillion in interest rate expense. What are we doing? Absolutely. Jay Powell knows it. The higher yields are coming through as higher costs. The second thing he said was how it's going to weigh down on the economy. He just allows people to assume that the weighing down on the economy means that the economy is going to slow down. But if you guys ever looked at a supply demand curve and you understood how prices work, well, then this should be, pretty easy to understand. I'm trying to simplify it. So here we go. If you're a company and you create a product and there's a lot of demand on that product, let's say you create like a million units, and you just launched that product. And now, like after 2 weeks, you already sold half of the amount of units that you produced, and the orders keep coming in. Well, you have to stave off demand. You have to find a way to reduce demand, or else you're going to run out of product. And if you run out of product, people might go away and lose interest. You never want to be able to have someone come to your store and click the button and it says out of stock. They might not ever come back. So what does the company do in order to fight off demand? They raise the price. That's how you fight off demand. So how does this weigh on the economy? This doesn't weigh on the economy with lower prices. Look, when a company sends you a coupon for 10% or 20%, they're trying to create demand by lowering the price. Right? So if he was fighting prices and lowering prices, he would be making the economy hotter. That's not weighting down the economy. That's propping it up. What he's saying is it's going to weight down the economy. How does it weight down? Well, higher costs pass through the cost structures into businesses and families and to government. It's going to push prices up. And as those prices get pushed up, that's how demand gets dampened. So he is literally telling you verbatim in simple English that what they're doing is causing the prices to go up. But at the same time, he's telling you, because the prices are going up, I'm going to keep raising those interest rates. I'm going to stay higher for longer. But because he's staying higher, it's all feeding. It's like a negative feedback loop, like the opposite of Bitcoin. Bitcoin's got the positive feedback loop. This has the negative feedback loop, and there's nothing you can do or say, or there's no lie you can really even tell to get out of it, because it's all math, right? We're showing you math. James here is showing you math. He's showing you chart. I'm showing you math in my tweets. I'm running the numbers for you. Don't believe me? Run the numbers for yourself. Math doesn't lie. It's the narrative pushers that need to lie. And he got caught right there. He got caught right there, revealing the number one problem in their strategy, which is we're trying to fight higher prices by causing higher prices.
Oh man. And then this leans in perfectly to what you tagged me on earlier. This tweet right here. You just can't figure it out. Can't quite figure out what is going on. And you said no one is this dumb. It's corruption. So what are these charts? What are we looking at here? Or actually, here's the quote tweet, guys, for you. Maybe you guys can see it at the bottom. It says, Goolsby, need to work out what's driving long rates up. And CJ responds, just can't quite figure it out. Mind blown. No one is this dumb. It's corruption. Opt out of lying. Hashtag Bitcoin. And we got some charts here. So explain to us what's going on here, CJ.
Absolutely. So right here is the dichotomy between the spending and the earning. And the blue line is what the government is earning, and past the dashed line is projected earnings, and then past and projected spending. So what you're seeing here is going into 2050. The government is telling us, and this is from the Peterson Foundation, but if you go to the Congressional Budget Office, they have this very similar same data here. So this is not, this is actually accurate, and it can be found on the CBO or here. And spending is increasing while revenues are pretty much flatlined. So what that's telling you is that the deficit's going to grow. So the government doesn't see any problem with spending more money than they collect in taxes. They don't understand that when you deficit spend new currency units that you borrowed into circulation, it creates inflation. So they don't understand the consequence of their deficit budget. And this chart is showing you exactly why they don't understand it. And if they did understand it, you would see the red line start to come back below like it did in 1998. Red line came below the blue line. If they knew what they were doing, they would make that red line come below the blue line. Instead, the gap is getting wider. The spread is getting further and further away. The deficit spending is going to continue to increase because this is the Keynesian model. This is their modern monetary theory mindset where they redefine how the free market actually works. But the free market is now pushing back and saying, we're going to call BS on your theory, and we are going to not trust you that you're going to be able to maintain 2%, because look at what the government's saying. The government is telling us they're not going to maintain 2%. There's no possible way you can increase spending at that rate and have revenues flatlined with an increasing deficit and maintain 2%, because it's that deficit budget, it's that deficit spending that is creating the inflation rate. So Fed Powell is like trying to blame the economy. He's trying to blame, like, the economy is too hot. Like, I just need to punish you guys because you just won't stop spending. You're so strong. You know, at the same time, the most people in ever have 2 and 3 jobs. You know, a strong labor economy is not, you have to have 2 or 3 jobs to get by. A strong labor economy is that the man can work 1 job, the wife can stay home and raise the kids, and you get to enjoy a high quality of lifestyle and standard of living. That's a strong jobs market. A jobs market that requires a person to have 3 jobs just to get by, that's a weak labor market. So he's attacking the labor market. He's blaming everybody else except the federal government. And he's even acknowledging those costs for the businesses and the family and just ignoring that fact for the government and the fact that it's going to weigh down on us through these additional cost structures. Every time you see this red line increasing and the deficit increases and inflation goes up, that devalues the dollar. That weakens the purchasing power of the dollar. Now, what's really interesting is that gold has maintained its value for thousands of years through multiple reserve currencies that have been traded against it. Well, the way gold maintained its purchasing power was that as the dollar devalued, the cost to pull the gold out of the ground went up, right? Because the the value of the labor, it didn't keep up with inflation, but it definitely went up. And the value of the equipment and everything else that goes into it, as those prices rise, the cost for the gold miner rises. And the cost for the gold miner, when that rises, he needs to raise the front end price. And why is that? Well, let's go back to business 101. Look, if you started a business and you don't understand that you need to create profit, you should sell your business right away. Close down your business and sell it. Go get a job, because at least you'll make money, right? You don't run a business to not make money. You run a business to profit. So if the product or the service that you're bringing to the marketplace has a cost, the cost is your baseline. The cost, you cannot sell the product or service for less than the cost. So if your customer sees the value in your good or service's value proposition, then they must pay a price above the cost, or else you're going to go out of business. And if you go out of business, the supply of that good or service declines and the price goes up even higher, right? Because that's the way the free market works, is the supply drops. If the demand's still there, the price goes up. So you can't get past this, right? This is not the labor theory of value. This is business 101. You offer products and services for higher than your cost. And if a competitor can do it better, well, that's a different conversation. But that cost is every business's baseline. But this is the magic thing about Bitcoin. Unlike gold, which value goes up relative to the devaluation of the dollar and to the devaluation of the dollar only, Bitcoin's price will not protect your purchasing power only because of the devaluation of the dollar, but also because of the difficulty adjustment. So imagine more people start mining gold, and yeah, the supplies get a little bit more expensive to buy, so the cost goes up a little bit, but it doesn't require any more energy to pull the gold out of the ground. With Bitcoin, yes, the price is going to go up a little bit because the price of hash rate is increasing, because the demand on that is increasing. But at the same time, as the hash rate increases, the difficulty increases. And as the difficulty increases, the cost increases. So as we're talking about all this stuff, don't get too heavy on yourself. Don't let your spirits get low, because Bitcoin is the solution to the very problem that we're talking about today. It was strategically engineered to solve this problem, and it's here to protect our purchasing power long after this fiat shitcoins are gone. So don't get too low in spirit with what's going on, but acknowledge it. Acknowledge what's going on. Prepare yourself, prepare your family, because look, the government is telling you what they're going to do, and they're not going to change that.
Love it. Yeah. And we'll bring in Bitcoin into this conversation towards the end, but I think it's very, very insightful to just show people where we are. So, I think you tweeted earlier today, you're like, I'm not an alarmist, I'm a realist, and sometimes you need a dose of reality. But here, let's go to the next chart you tagged us in. So what are we seeing in this chart, CJ?
So this one is actually more alarming, but in the red, you see the exponential growth of the debt. In the green, you see declining revenues. And in the orange, you see the increasing deficit. So, as the interest rates go up, the revenues are going to go down, and the debt is going to go up, and the deficit is going to go up. That is the perfect storm for getting crushed. And Opti, actually, if you could, I'd really appreciate if you could pull up the US debt clock, which is usdebtclock.org. Because
I got you.
I've been watching the US debt clock for close to 14 years now. And in my recollection, this is the only time where we have seen what you're about to see with your own eyes. Look right there in the top left, you have the debt 33.7, but move over US tax revenue. Yeah, no, zoom back in like that. That was beautiful. Yeah. Okay. So the national debt is going up. The deficit is going up. But look what's happening to the revenue. It's going down. Let me ask Jay Powell a question.
Oh.
If the economy was growing by 4.9%, because that's what they said GDP was, 4.9%, how is the tax revenue going down? How do you have an economy when you maybe even better for people to realize this? I got you running around here, Opti. I apologize, but you're good at it.
No worries. So what do you need?
I think going to Shadow Stats. I think if you go to shadowstats.com and we show the GDP chart, it will kind of give you an idea of how ludicrous the claims that the Bureau of Labor Statistics are putting out. The manipulation of the data is so bad at this point that I am actually working on my own website that puts together all this, because every once in a while I sit down and I plug all these numbers into the equations just to see where we're at. And I'm getting annoyed with it. So I want to automate the process, and I'm going to create that website so that everybody has access to the most important numbers that any macro manager can have access to. And when you get that up on the GDP on Shadow Stats, what we're going to see is that the government is claiming with 4.9% GDP that we're not just growing faster than we were pre-COVID. We're growing faster than we were going all the way back to the early 80s. So they're saying that this is the most growth, and I'm still seeing the debt clock. I'm not sure if everybody is still.
Yeah, here we go. I'm trying to find it on the site.
Okay, so. Yeah, so go to alternate data.
Okay.
Yeah, that's fine. Yep, and then gross domestic product. There we go. Boom. So the blue line is actually accounting for real inflation. The red line is what the government claims. Well, take a look at where that red line, they're saying that we're at 4.9%. That's more growth than pre-COVID, of course, but that's more growth going all the way back to the early 80s. They're saying we have these, after doing the largest, most aggressive interest rate hike in modern financial history, they're saying we have the strongest economy because the data is botched. Inflation is not being accounted for properly. When you look at GDP, they're supposed to, just like when you find real rates, right? Where we talked about real rates, the nominal rate is 5.5%. If we believe the Fed and the inflation rate is 2%, then our real rate of return is the 5% minus the 2%, which is the 3.5%. Well, in GDP, it works the same way. You have what's called the GDP deflator, and that's how you go from nominal to real. So they're saying that GDP is 3.5%. So they're deflating GDP by 3.5%, but inflation is not 3.5%. So that's why the GDP number is the nominal number that they're promoting to promote their narrative is telling us that we have the strongest economy since the early 80s. That's just not true, because when you account for real inflation, look at the blue line. Growth is still negative. We have only shrunk less and less since COVID. We have not experienced any real growth. Now, a lot of people know that the definition of a recession is 2 consecutive quarters of negative GDP. Well, the definition of a depression is 1 quarter of greater than negative 10% GDP, or 12 consecutive quarters of negative GDP. Well, you'll see there in 2020, we went just below the 10%. So in 2020, we actually entered and fit into the definition of a depression. Now, of course, it was an artificial depression based on the lockdowns, but we met that definition. Now, what's concerning is that we met the definition of an artificial depression through the lockdown, which brought us to negative 10%. But since then, we have not been positive. We've been shrinking less and less, absolutely, because we're recovering. But we've never gone positive. And if GDP doesn't turn positive by the end of this quarter, this is the 12th quarter. So we will have met, the United States of America will have met both definitions of a depression, both at least 1 year of greater than negative 10% GDP, plus 12 consecutive quarters of negative GDP. Meanwhile, the government is telling you we have the strongest economy since the early 80s. The mishandling of inflation is what's skewing all of the data. So then you have to ask yourself, okay, well, are they botching this, or are they incentivized to do this? Well, everybody in Bitcoin knows that funny scammer saying where it's like, hey, send me a Bitcoin, I'll send you 2 back, right? Have you ever heard a scammer tell you, hey, send me 1 Bitcoin and I'll send you 0.95 back? Well, hell no, they never said that, because there's no incentive for the person to send the Bitcoin. Why would I send you 1 Bitcoin to get less back? I want more back. Well, the government, in the same way the government is incentivized to tell you a lower inflation number. right? Because when they tell you a lower inflation number, that's the equivalent of creating a fake real yield that's higher than it really is, right? Because you take the 5% that you get on the 3-month, you subtract it from their 2% claim, and you got real growth of 3% year over year. But if you take the 5% and you subtract the 7.5% real inflation, you're at negative. So why would we lend the government money and expect to get a negative return? Why would we send the Bitcoin scammer a Bitcoin because he promised to give us 0.95 Bitcoin back, right? The Federal Reserve is not, they're smarter than that. So they're incentivized to state a lower inflation number, because the lower inflation number allows you to subtract a smaller number from the nominal yield, which fluffs up the real yield number. And because they have that incentive, people really shouldn't be trusting their data, a lot like why you shouldn't have trusted a lot of the vax data, that it was safe, it was tested. I mean, the right amount of time didn't pass by to do the proper testing. So it's unfair to say that it was safely and properly tested, because the right amount of time didn't even go by to do the right, safe, and proper testing. It's just obvious. But they had incentive to lie about it because they made billions of dollars. Well, the government has an incentive to lie about the inflation, because as long as they can make us think that we have a real yield, a real rate of return that's positive and not negative, then we'll keep lending them money. And that's what the market is figuring out. The market is starting to figure out, this is unbelievable. They've been telling me this, but the reality is this. And when I adjust to the reality, I'm actually sending this guy a Bitcoin and getting 0.95 back. This is not going to work. I don't want to lend my money to them. And people are selling the debt because the debt is being devalued, because the people are waking up to the fact that the data is not accurate. And it's not just, that's why the inflation number is so important. If anybody ever asked, why are they so focused on inflation? Because inflation plugs into everything. It plugs into real GDP. It plugs into real yields. It plugs into real sales. Inflation is the number that you subtract from the nominal sales or GDP or yield to get the real number. So they want to manipulate the real number. And in order to manipulate the real number, it's not just about manipulating the nominal yields. It's about manipulating the deflator that you use, the inflation number that's subtracted from that nominal number that gives the real number. And that's where the marketplace incentives come from. So if real yields are positive and you can grow your purchasing power over time, then the marketplace is incentivizing you to save, right? If you can grow your purchasing power over time, then it makes sense to save, not to spend or invest. Save, because you can buy more tomorrow. But when the real rate of return is negative, the marketplace is incentivizing you to spend or invest, because you're going to be able to buy less tomorrow. You'll be able to buy less food, smaller house, less shares of the company, because the real rate is negative, and it incentivizes you to spend or invest when the real rate is negative. So that's the breaking apart of the market right now. Some people in the market, you got the Ray Dalios and some of these bigger guys coming out, the Paul Tudor Jones, they're coming out and saying, hey, we're not being compensated enough for this, so we don't want to hold the debt, because the real rate of inflation is actually higher than what they're saying. Therefore, my real yield is negative. Therefore, I'm going to spend or I'm going to invest. I'm not going to save, because I'm not gaining any purchasing power. I'm sending 1 Bitcoin and getting 0.95 back. I want to send 1 Bitcoin and get 1.1 Bitcoin back. I need to increase my purchasing power, not decrease it. So that's what's really going on here with the manipulation of the inflation data. And that's why the focus is on the inflation data, because it plugs into everything else in order for the marketplace to determine what those incentives are. And half the marketplace, or maybe 3/4 of the marketplace, believes the Fed and thinks the rate is positive. And that's the $21 billion that piled into TLT, plus literally trillions of dollars that was lent directly to the government. And then the other half is saying, well, real yields are negative, so I'm not going to lend my money. I'm going to spend it or invest it, because I'll get more today than I will tomorrow. And that's where the marketplace is right now. And we're on the brink. we're on the brink of more people realizing it than not. And that's when everything will shift. That's the catalyst.
Absolutely incredible, CJ. Before I reel this back into Bitcoin, we are almost at the top of the hour. I told everyone we might go long. Me and CJ were chuckling about it. You did this tweet the other day, and we've been constantly harping on a similar idea, and you just kind of doubled down on it. We've been saying for a while on the show that World War III is an information war. And here you have a tweet. World War III is an economic war, and it's being fought in the field of finance. So maybe tie all this together. How does this relate in the global geopolitical sense of the words? And then we'll give some people some relief and talk about how Bitcoin fixes this.
Yeah, absolutely. So, the whole goal. See, this is what I call the fiat perpetual war cycle. And what happens is that the currency marketplace, the FX marketplace, what it allows countries to do is to issue their debt. And ultimately what that does is it creates demand for dollars. So basically, because of dollar denominated debt, there's almost an unlimited bid on dollars. So what that does is at some point in time or another, that demand hits the dollar. When the demand hits the dollar, DXY goes up. Well, when DXY goes up, the treasury can issue more debt. And yeah, it'll make DXY go down, but it's really just offsetting the positive pressure that was created through all the dollar denominated debt. So if you keep going through that process, you can fund war perpetually, right? Because a country will issue a treasury or a debt note and use that money to pay for the war, and they'll issue it in the imagine there's the FX market, it's the currency market. It's like Bitcoin, it's its own marketplace. Well, governments have currency markets that are their own marketplace, and fiat makes it possible. So the entire fiat system is based on war. But what we're seeing right now is a world war between the parties within that system. So we have a perpetual war system, and then we have the parties within that system now fighting and jockeying for a position with each other. And the whole name of the game is for BRICS, who could never beat the dollar. I mean, I don't care what BRICS does. There's nothing that they can do. Even if they back their currency with gold, it's not going to threaten the dollar, because countries aren't issuing debt that creates demand on BRICS currency. It's dollar denominated debt. And yeah, this is just to show you, a lot of people say that DXY, if you notice in 2021, we had all-time high inflation, right? But what was the dollar doing? It went up. It went up. Look when the Fed started raising interest rates. Well, have they stopped raising interest rates? No. But look at the channel that we were in up until recently. It was going down. So we had disinflation, or we had inflation at a slower rate, and DXY went down. Be careful out there who you're listening to, who's people that use DXY to try to see what price trends are going to happen for assets, or what's going to happen with inflation. Because, when the dollar went up, you'd think prices would go down. But at the same time the dollar went up, we had all-time high inflation. And then starting in that October, something happened, the trend changed, and we had disinflation, right? Official inflation went down from 9 all the way down to where we are now, but the dollar went down too. So you have to be careful where you're looking at here. And that neckline there is the head and shoulders pattern. And actually the updated chart is we've broken below that. So the dollar is getting a little bit weaker right now. And I think that's because people are anticipating that they're going to lower rates, but they're not going to lower rates because they're trying to fight the prices, right? So that goes back to the original conversation we had. And as they're fighting those rates, they're issuing treasuries. The rest of the world, the World War III is economic and being fought in the field of finance because the rest of the world sees what's happening and is saying, well, we can't beat the dollar, but what we can do is we can reduce the amount of demand on the dollar. And that's really their strategy. Their goal is, let's reduce the amount of demand on the dollar. And as they reduce the overall amount of demand on the dollar, slowly but surely, like a war of attrition, and at the same time, the United States government is increasing the supply. Well, look, the natural laws of economics that apply equally all over the world tell us that when supply goes up and demand goes down, price goes down. So yields are going to skyrocket. Yields are going to go up because as the note and bond prices go down, because the supply is going up, at the same time the demand is going down, the bond and note prices are going to go down, which pushes the yield up. So there's really nothing that they can do except control the narrative and maintain people's trust. And that's why I think it's important for people to start talking about financial COVID, because we have a data problem here. And if we can fix this data problem, like a fallen angel standing in front of God, we'll be able to see through the facade. We will be able to see that that is not a real angel, it's a fallen angel. We'll be able to see that the economy is not that strong. We were in an artificial depression where since then we've been in recession. And by the end of the year, if real GDP doesn't turn positive, we will be in a real depression. And then the next step of that is, well, are they going to let everything fall apart? They're not going to let everything fall apart. If they were going to let everything fall apart, it would have already fell apart in March, right? The banks are already bankrupt. Everybody's sitting around like, oh, everything's okay. Nothing crazy happened. The banks are bankrupt. Your money's gone. They took your money. They went out the yield curve, and then all of that mark-to-market value is gone. So they have a couple of accounting trips where oh, well, we're not going to sell that 30-year bond until we have to. So we mark it down as a hold to maturity value. So yeah, even though it's $1 billion bond and right now it's only worth 600 million, well, we don't care. On our book, it's still worth $1 billion. On our book, that bond is still backing $1 billion of our customers' deposits, right? So in March, when the customers came back and said, hey, we want our money because you're paying us 0.1% and this money market fund is going to offer me 5%. So I want my money. I want to take my money over to them where I can get 5 instead of 0.1. Well, the banks, where are they supposed to get the money? They have to sell the collateral, the not pristine collateral that lost all its value. They have to sell it. Well, they have to sell it at a loss, right? So hold to maturity accounting only works until it doesn't. And that's why the Federal Reserve, if they were going to let everything de-lever, if they were going to take the leverage out of the system, if we were going to experience deflationary price action, it would have happened in March because they would have never created the Bank Term Funding Program. The Bank Term Funding Program from the Federal Reserve said, hey guys, we know that you need the money for your asset in order to cover your customers' deposit liabilities. And we also understand that if you took that asset and went to market, you would go bankrupt. You're insolvent. So in order to keep you from failing, you can just bring that collateral to us and we're going to pretend that it's pristine. We're going to pretend that it's par value. So yeah, that bond that you paid $1 billion for is now only worth 600 million. But if you come to us, we'll let you borrow from that. We'll let you use it as collateral and we'll value it at par. We'll value it at the billion. That way the bank could get the full billion that they needed to give to their customers so they could go where they wanted to go. And that Bank Term Funding Program is the proof that if they wanted the system to delever, if they wanted to create a deflationary scenario, then that's when they would have let it happen. But they didn't. They created the program and they maintained the status quo. And a lot of people say, well, what's that mean, CJ? Like, what? How can they do that? How is this happening? Why is it happening? Well, it's because we don't live in a democracy anymore. We had a republic. It devolved into a democracy, and then it devolved into kleptocracy. And for people who don't know, a kleptocracy is simply a body of power elites who fight over the power of the purse, right? Because the government, through a vote, has the right to create money. They can print money out of thin air. And unfortunately, that's where we are right now. The politicians don't care about the people. They care about the people who pay their bills and get them elected and donate to them. So when they get those donations and they get that backing, they make a promise to that person. Oh yeah, sure, no problem. We're going to get money for solar panels. We're going to do this. We're going to do that. And then when they get to DC, they talk to other politicians that say, well, look, I don't really give two craps about your constituents, and you don't really give two craps about my constituents, but we have one thing in common. Your constituents need money and my constituents need money. So if you support me, I'll support you. That's how you get multi-thousand page bills with all this different stuff. You'll notice there's never a bill that passes with just one thing in it because not everybody cares about that one person or that one thing. What they care about has to be included into the bill. So thousands of cares are forced into these bills so that everybody gets a piece of the treasure pot, a piece of the piggy bank. No one person can get a piece of the piggy bank. If you're going to reach in the piggy bank, we're all going to reach in the piggy bank at the same time. And that's how it works. So it's a kleptocracy. It's about a group of power brokers who have access to the printers, basically, and they sell that access to the printer. And that's really where we're at right now. I don't think they want to destroy the system. I don't think they want to do some big reset. I don't think they're that organized, or at least I hope and pray they're not that organized. I think it's just kleptocracy. It's everybody looking out for themselves to maintain the status quo, because as long as they can maintain the status quo, they all get to keep picking out of the piggy bank, right? If everybody's happy, even if we create some inflation, even if whatever the consequences are, they don't care, because it's about maintaining the status quo, because the status quo is what allows them to keep picking from the piggy bank. If we adopt Bitcoin, if we, the people, step up and say, we're not going to let you pick from the piggy bank anymore. Well, how are we going to do that? Are we going to do that violently? No, of course not. Most of us have families and kids, and we just want to live life peaceably. We're not interested in violence. Bitcoin is a peaceful revolution. And the reason is because the way Bitcoin is created, it takes away their ability to raid the piggy bank, right? They can only ever spend what they collect in tax. They can't spend more, and they can't create more Bitcoin and spend it into circulation. It takes away the power of the purse. It gets rid of this kleptocracy and gets those politicians back into the mindset of being a servant to we the people, rather than stealing through inflation from we the people. And that's why Bitcoin is the solution to the inflation problem. It takes away the power of the purse. And that's what's most important in a kleptocracy like we have today, the power of the purse. So the status quo is going to remain. They're always going to take the politically expedient solution because it maintains the status quo. Nobody wants to do the tough and right thing and let companies fail, right? Too big to fail. Where did that come from? Too big to fail came from, well, shit, if they're too big to fail and then they actually fail, we lose the status quo. So we got to do what we got to do to maintain the status quo. And in 2008, it was pretty bad, but since COVID, it's gone to a whole nother level. It's gone to, I think the dollar supply, nobody really knows for sure, but based on my research, since 2020, the dollar supply has been expanded upwards of 80%. So it's no rhyme or reason or wonder why prices keep going up. Even if inflation has gone down from 9% to 3.7%, that doesn't mean the prices went down. That means the prices are still going up. They're just going up a little bit slower. And the reason they're going up a little bit slower is because they raised interest rates. And when they raised interest rates, the dollar gained a little bit of strength in there, right? So there was a temporary reprieve through the effects of raising interest rates. But now those effects are going away because they've reached a cap. They've reached a limit on interest rates. And I think one more thing to kind of put the final nail in the coffin here, I have a tweet about yield curve normalization. And I want people to understand that, because that's the signal I'm watching. Every morning I look up and I look at the 10-year to 3-month yield curve, because I know that once that yield curve normalizes.
Is it this one? Let me see. Simply can't emphasize enough how important this yield curve conversion.
Let me see. Can you scroll down a little bit? Because I go by the no, it's not that one.
Okay, I'll find it.
It's got a let me just describe what the normalization process is. So like we talked about earlier, while you're looking for that, the process of normalization is the long-term rates going back above the short-term rates, right? And actually to this day, we've had the longest, steepest yield curve inversion between the 10-year Treasury note and the 3-month Treasury bill in its recorded history. So what that's telling you is the marketplace has trusted the Fed. They trusted the Fed so much that it created the longest and the steepest yield curve inversion in its recorded history. But if you go back and you look at the chart, and on that chart, Opti, it's like the 10-year minus the 3-month. It's a Fred chart. There's 2 red lines. I talk about normalization, and there's what's called a interest rate spread, right? So it'll be the difference between the 3-month bill rate and the 10-year note rate. Well, historically, once the yield curve uninverts, the spread between the 10-year and the 3-month, it ranges between 2 and 4%. Well, that's really important because right now the 3-month bill is at 5.5%. So if we get a normalization, in other words, if enough people say, I don't believe your 2% inflation target, the Federal Reserve starts to lose control of the long end of the yield curve. Like in that one tweet, his comment was, trying to figure out what's happening with the long end of the curve, can't just figure it out, because he can't say out loud, oh, people are starting to lose trust in us. People are starting to question our 2% target. And as they question 2% target, those yields have to rise because those people are looking to be incentivized. And to be incentivized, the real rate has to be positive. So those yields have to keep going up. Well, with the 3-month bill at 5.5%, if we normalized, the 10-year would go all the way up. Yeah, so you can see the 10 years, the candles, the 3-month is the green line. If the candles go above the green line and the 10-year rate goes above the green rate, the historical spread, in other words, there's going to be a crash. Treasuries will sell off so fast that it will be hard to comprehend. And it will be 2 to 4%. So 5.5% plus 2% is 7.5%. And 5.5% plus 4%, right? Because that's the spread, 2 to 4%, is 9.5%. So you'll see the 10-year note post normalization shoot to 7.5% all the way up to 9.5%. And remember about what we first talked about. The higher the rate goes, the larger the deficit. The larger the deficit, the more they need to print. The more they print, the larger the inflation number. The larger the inflation number, the more real yields go negative. So this is the debt spiral that people are waking up to. And that what you want to keep an eye on is actually, Opti, I know you can pull this up fast. If you pull up a tab and just type in FRED, F-R-E-D, 10-year minus 3-month, and click enter, it should be the top result. And everybody will be able to at least visualize it and see what I'm talking about here. Because what this chart does, yeah, beautiful. Now just zoom it all the way out, like at the bottom, pull that, yeah, go straight down, pull that thing there all the way out. There we go. Okay, so what you'll see is, and actually what I want you to do is pull that same bar back so that I can show people there that very first thing actually did go. So not that one, the one on the right. Pull that one on the right all the way back to like 1985, all the way back. Keep going, keep going, keep going. Good. Okay, see how the rate went, it did go negative there. So I just wanted people to, I don't want people to be like, hey, CJ, what you said wasn't true. No, there was an inversion and then there was recession. Okay, so now you can zoom it all the way back out. I don't know why it does that. Because you know why? The government can't even code charts. That's why. But it doesn't look like it was inverted there, but it was inverted there. So you have the inversion, the normalization, recession. And then in the 90s there, inversion, normalization, recession. The gray shaded areas are the recessions. Then in 2000, inversion, normalization, recession. Inversion, normalization, recession. And then COVID, inversion, normalization, recession. So right now, look how steep that inversion was. That was the steepest inversion in the history of the recorded relationship between the 10-year and the 3-month. Now, if you measure the amount of time of these inversions, right now, we are in the longest lasting inversion in the recorded history of the 10-year and the 3-month. What does that mean? That means that the market has trusted the Fed. But what the Fed officials came out and said today is, we can't understand this big V shape here. We don't understand why we're getting this V-shaped design and we're heading back towards the zero line. Why are we heading towards normalization? Why are long-term yields going up? Well, because the free market is calling your bluff. The free market is saying inflation isn't 2%. Therefore, in order for me to continue to lend to you, I need higher rates of return. And they're going to sell that debt until it gets to the point of that rate of return being real. But then if they really know how to do the math, they're going to understand, oh my God, when it goes up to 7.5 to 9.5%, well, the number I have to subtract from that 7.5% is going to be larger than what it is now. It can never get positive. They will never be able to make real yields positive. That is like the biggest piece of news that nobody is talking about. There's no way, because of the $34 trillion of debt, the $211 trillion of unfunded liabilities that all need to be financed and rolled over, plus the ongoing deficit budget that they plan to continue to grow, There is no way to get the real yield to be a positive number. There's no way. They're stuck. And this is what people need to understand. And once they do, you're not going to be able to get out of the dollar fast enough. You're going to see a crash. You're going to see yields shoot up to double digits, and not just 10, 15%. They're going to go Weimar level, 20, 30% yields. And unfortunately, some people will still get suckered in. But look no further than Argentina to understand that even if you put the interest rate above the rate, I think their interest rate is like 136%. But their real inflation, now the government inflation rate is smaller. It's like 110%, but that's a lie. They're lying about their inflation rate too. Real inflation in Argentina is closer to like 200%. So it doesn't matter how much you raise the rate. You could literally be paying people 136% APY, and it wouldn't matter because you're paying the APY with diluted tokens, with diluted fiat currency coins that have no real, you can't create value out of thin air, right? So they steal their value from all the existing tokens. That increases the inflation rate and lowers the real rate. That's where we are right now. That's what's important for people to understand. And if I were you, I would be keeping an eagle eye on the 10-year note rate minus the 3-month bill rate, because when that normalizes, that will be the catalyst to long-term yields skyrocketing. And then investors having to ask, what the hell just happened? How did this just happen? And what are the consequences? And what are the real numbers, right? Because nobody really pays attention till they're forced to pay attention. Just like nobody really cared that the banks were insolvent until people wanted to move their money from the banks to the money market funds. Then it mattered. Well, very soon it's going to matter that they don't have control of the yield curve. And if they try to do yield curve control, money printing, right? More inflation. There's one solution they have: inflation, not deflation. Right? Everybody on the sidelines waiting in their money, waiting for deflation. We are in an inflationary recession. Remember the GDP chart. We're in a recession right now. We are about to be we're in an artificial depression. I'm giving them that. Okay, that -10 was because of lockdown. It's artificial. But real rate is negative. The real growth rate is negative. We have not had any economic growth at all. We've just been shrinking less and less. We're still trying to recover. And they're trying to take advantage of that. There's nothing they can do to get out of it. We're in an inflationary recession right now. Economic growth is negative and prices are still going up. Jay Powell told you himself, the costs are going up. The prices are going up. Maybe one day they'll have to sit down and ask, dang, what causes more inflation? Increased cost structures for businesses or lower interest rates? Because I think what we're going to find out is that increased cost structures anchor inflation, and that's not transitory. That's not transitory inflation. That inflation is not going away. If you have monetary inflation, then maybe there's something you can do to try to dampen it. But if you have structural inflation, it's not going away. And that's the next inflation wave. The next wave of inflation is going to be based on the structural inflation through the cost structures of businesses and families and the government deficit increasing. And then they're going to lower rates and print more money. And you're going to get it from both sides. You're going to have structural, sticky inflation, which isn't going to go away overnight. And then at the same time, you're going to have monetary inflation, and you're going to get a double dose of inflation. And that will force the government to even admit to new all-time highs of inflation, even though they don't want to, and they're incentivized not to tell you that. They'll still be forced to tell you that. And at some point in time, we have to break off of their data and not take their interpretation of the data and get the real data so that we can understand what we are incentivized to do by the marketplace, which is always going to be based on the real yield, not the nominal, the real yield. So for everybody listening, make sure you're calculating your real yield so that you can understand how to position yourself and how to allocate your portfolio as we go through what the Fed is calling this higher for longer streak.
Wow, hold on. Absolutely incredible. Absolutely incredible. Haven't heard it like this, laid out so eloquently, showing all the consequences, all the charts. Just to bring this back, we are at an hour and 15 minutes. Let's bring this back to Bitcoin at the end. It was just November 5th. Everyone, knows the means. Remember the 5th of November. And just to sum this up, and I do have a tweet here where you say Bitcoin is cheap. Let's connect Bitcoin. You say it right here at the bottom. Bitcoin takes away the government's power of the purse and returns it to we the people where it properly belongs. So absolutely love this. And CJ, thank you so much for coming on. But let's touch on Bitcoin for a moment. You also recently tweeted, is it this one? Yes, this one. Bitcoin is cheap. So let's connect all these thoughts together. How does Bitcoin fix this? Is it a good time to be buying Bitcoin? Should people be saving in Bitcoin? How do we wrap this up and put a bow tie into this for the people out there?
Absolutely. And a fantastic question, Oppie. Fantastic. So actually what I'm going to ask you to do is I've been creating what I call rabbit holes. You'll notice in my tweets, you might end up 6 or 7 pages deep because I keep quote tweeting on top of quote tweets to help you get down the rabbit hole. So go ahead and click that quote tweet there and then scroll down to the bottom of that one. And now click that one. There we go. Okay. This is what we were talking about with cost structures, right? There's only one question you need to be answered to be a successful investor. And that is what I'm buying cheap. So in this case scenario, is Bitcoin cheap? Well, it's a simple rule. You buy X when it's cheap, you sell it when it's expensive. So how do you know how to answer this question? My strategy is to take the producer's cost of production, right? So if I'm looking at real estate, and I know that this is a beautiful single family home, 4,500 square feet, awesome piece of land. And what it's going to cost $2 million to replace this home, right? So there's no way, even if you had all the connections, you had a developer, you had contractors, you can't build this house for less than $2 million. So if the price of the house was less than $2 million, I would buy it without hesitation because the price is below the cost. The price is below in real estate, what they call the replacement costs. With Bitcoin, we call it the cost of production. I call it the cost of production. Satoshi actually called it the cost of generating. So the cost of generating Bitcoin is your baseline. We need to know how much does it cost to generate a Bitcoin? Because once you understand that, you go back to business 101. The miners can't sell you the Bitcoin for less than it costs you them to generate it. They'll go out of business. And if you believe in the value proposition of Bitcoin, if you believe that sovereign truth money is a valuable proposition to your life, well, then you're going to pay above the cost because you have to. And if you don't, well, the economic consequences will hit you. So what you see here in this chart is the red place, that red, what I call a price cloud, right? And the top of the price cloud is the all-in cost of production. This is based on an average, and this is based on worldwide. So, there's probably a few institutional miners who are not paying these prices. And this is an older chart. So what I want to show you through this chart before we go back to the other one, Opti, is what is the commodity cycle, right? Bitcoin is commoditized energy in the form of money, and price discovery is a commodity cycle. So when the price is at the top of the red cloud, which is the average all-in cost of production, that's called fair value. You can see that marked in orange. When price goes to a discount to the all-in cost of production, it's like when that company sends you a coupon. You can buy it for less. You can buy it for cheaper. It's when you want to buy, when the price is in the red cloud because it's less than the all-in average cost of production. That's your discount zone. So you want to buy Bitcoin when it's cheap in its discount zone. And when it's at fair value, yeah, you can continue to stack. You're getting a fair deal. But what happens when the price goes way above the red cloud? It goes into what's called a price premium, right? So now imagine that $2 million house isn't for sale for 1.8. It's not below cost. It's not below replace. It's not a good deal anymore. It's not cheap. It's expensive because now it's listed for $4 million. It's twice the amount of the replacement cost. So what you'll see is price goes from premium to fair value to discount, back to fair value to premium to fair value to discount. And it's a cycle. That is the Bitcoin commodity cycle. Now, one thing I want to point out here, look what happened there in the bear market of 2018. You see how price went down into the red cloud there in 2018? It was at a discount. It was super cheap. Price was in the red cloud. And then look what happened during COVID. Price was kind of right above the cloud. And you know why it was at fair value? Because look what the halving did. That black line is the halving. Look what happened to the price cloud because of the halving. The halving is the catalyst to a new price discovery cycle because the cost for miners double overnight. You could see the cloud, it doubled overnight because the rewards go down minus 50%. And that translates to a doubling of cost. Well, where did price go? It went right back to where it needed to be, right back where the miners needed it to be in business, right? Because you can't buy it. You can't sell it for less than it costs you. You go out of business. So that's now go back to the original tweet you're in. So people understand the commodity cycle, because here's where we are today. Now you can make that chart bigger because this is boom right there. Look where price is, guys. Where's price? Is price above the price cloud? No, price is in the price cloud. Bitcoin is as cheap today as it was during the 2018 bear market. Bitcoin is as cheap today as it was during the 2020 liquidity crisis. Bitcoin is cheap today relative to its cost of production. And if you know what's happening with hash rate is going parabolic. We talked about it between the comparison between Bitcoin and gold. When hash rate price drives hash rate drives difficulty drives cost increases the floor price. This is the store of value mechanism that was engineered into Bitcoin. And what you're seeing with that red price floor growing, notice what happened after the China mining ban right there in the first big fall from that 65,000 peak. Where did the price come back down to? It came down to fair value because the miners had to sell everything they could to relocate. But did they sell at a loss? Hell no. They sold down to fair value. And then what happened when they stopped selling? Price went right back up to large premiums. And then the Federal Reserve announced their interest rate hikes. Where did it come back down to? Fair value, because we didn't know if they were bluffing or not. Then in March, when they finally started raising the interest rates there at the end of March, where did it go? It went to discount range. We entered the bear market for real when they really started raising interest rates. BTC is a commodity. It's commoditized energy in the form of money, and its price discovery cycle is a commodity cycle. Right now, we are at the point of maximum opportunity. Price is in the discount zone. Price is in the range where you want to buy it because it's cheap relative to its cost. Very soon, that is going to move up. And actually, the bottom of that price cloud is about $22,000. So in April, when the halving hits, guess what happens? The bottom of the price cloud doubles. It's going to go to $44,000. So right now, if you have the ability to make a bet on what the price of Bitcoin is going to be by the halving, well, maybe it'd be a good idea to say the price is going to be around $44,000, because if it's not, the miners are going to be in a lot of trouble, right? This worked for me perfectly during the 2020 halving, and it's going to work perfectly here because it's a natural law of economics. I expect price to be at $44,000 minimum going into the April halving, because that's where price needs to be. Just like you can see there, we had the coronavirus crisis, it went down into the cloud, it bounced up violently to be at the bottom of the cloud for the halving. Well, price can be anywhere within the cloud at the time of the halving. The top of this cloud's around $36,000. So it's a bit of a spread there, but historically price starts out at the bottom of the cloud, works its way up, trying to break out of fair value. And notice what it did. It took about 4 to 6 months after the 2020 halving. People were trying to figure out what's going on here. What's taking so long? We had to get out of the fair value range. The accumulation, once that stopped, look what happened to price. It went parabolic to premiums. Who sold into those premiums? The miners. Where'd they sell it down to? Fair value. When they stopped selling, what happened? Premiums. Who sold into it? Probably macro, probably miners as well. When they started raising interest rates, where did we go? Discount. When the halving happens in April, the cost of production on the electric side, on the bottom of the price cloud, will be at least $44,000. That's where price is going to be minimum in order for miners to maintain their business model, and in order for people to believe the value proposition of Bitcoin. If you want to benefit from the value proposition of Bitcoin after the April 2024 halving, it's going to cost you at least $44,000, because no miner in their right mind, maybe there's a few dumb ones out there, but nobody in their right mind is going to sell you it for less than it costs to produce. And the best of the best are going to be at the bottom of the price cloud, whereas the retail is more towards the top of the price cloud. But right now, Bitcoin is cheap. So don't use psychological price points like 40,000, 50,000, 60,000 to determine whether or not Bitcoin is cheap or not. You have to form a baseline, and that baseline is the cost. And you look at the market price relative to the cost. Bitcoin is cheap. Buy as much Bitcoin as you can when it's cheap, because premiums will come. That's part of the commodity cycle.
Wow, hold on. For everyone in the chat, here he goes.
Now listen, that's called motherfucking
And some applause. Wow, CJ, well, I'm sure we could sit here for another hour and a half, but let's end it on this note. I think we gave the audience a lot of food for thought there, and this will give me an excuse to bring you back on sooner than later. So I don't know, we'll have to figure out what's a good time. Maybe just the beginning of the year, once this quarter four ends. We'll update this and we'll see where we are. And of course, we'll bring you back on around the halving. We might have to just make CJ a regular. I know you're going to make content soon, but man, absolutely mind blown. I know for a fact I'm going to have to re-listen to this one. But I think at the end there, what more do we need to say, guys? You need to buy Bitcoin. But of course, CJ, I'll give you the floor. Last two sats on this conversation so we could tie this up. And then, of course, we'll let you go on your way and go hang out with your family and all that good stuff.
Well, thank you so much for having me, Opti. I really appreciate it. I love your audience. I love your platform. And you do a really good job of steering me. Everybody here knows I can go on and on. So thank you for doing that and for pulling up all those charts, helping everybody understand not only through words, but also visually what's happening. Because right now is the most important time in the history of finance. Never before have the debts been this large. Never before have the debt issuers that are the government been in this position. Never before have higher yields passed through as higher costs. We're seeing a change in the marketplace, and the smart money is starting to figure it out now. So if you're on the sidelines, thinking that we're going to get some type of depression, the probability of a small pullback, of some type of liquidity crisis event, it exists. Absolutely, it exists. We could get another March 2020 moment, but the reaction to that moment is going to be inflationary, not to allow the system to fall apart and crash and burn, because then they lose the status quo. So just remember, the ultimate goal of these people who have the decision-making power is to maintain the status quo. Don't let the macro interpretation affect your strategy. Understand the real rate of return. Understand that Bitcoin's compounding annual growth rate over the last 10 years is 70%. So unless there's some type of debt instrument that is paying you 70% with, I don't know, anything could pay that with the amount of risk that would be involved with that kind of yield. But Bitcoin's 10-year compounding annual growth rate is 70%. So it doesn't really matter if inflation is 5%, 10%, 15%, 20%. Say inflation goes to 20%. You're still going to increase your purchasing power on a 10-year timeline, roughly about 50% year over year in Bitcoin. You can't get that opportunity anywhere else. Bitcoin is the apex predator of how to store value. It was engineered to be that way. Now's the time to be telling your friends and family about what's going on. Now's the time to be paying attention. On my YouTube channel, I put together an orange pill playlist for the holidays. So check those videos out. They're all like a couple minutes long, because I know, nobody's going to be at dinner like, hey, watch this video. It's an hour long. It's impossible. These are all videos that are 90 seconds, 2 or 3 minutes. You can show it to a family member and just kind of let them have that mind explode moment where they're like, oh, I never heard it that way. I never thought. So I got a bunch of them in there. Use it this holiday season and use it out of love, because this is a peaceful revolution. Bitcoin is bringing us to a prosperous future with correct incentives and proper free market economics, not this manipulated fake growth, inflation, data manipulation system that we're in now, which is coming to an end. Don't let anybody tell you it's not coming to an end. All the bells are going off. All the whistles are going off. And people who know what are going on are doing, I might seem a little bit crazy, but you got to realize I've been wrong for 9 years, but now I'm right. So I've been wrong for a long time. I'm warning people about inflation. Inflation's 2%. CJ, who cares? Who cares? Yeah, but now they've lost control of the yield. Now they've lost control of the ability to incentivize people with higher yields. Now that you understand this, simplify it down. Comment to me. Share with me. Let's work together to wake up our family and friends, because this train is coming and nothing can stop it.
Absolutely incredible. Great. For the audience out there, CJ, what is your YouTube channel link?
I think it's just at CJ Constantinos, just like my Twitter, just at CJ Constantinos.
Sweet. Well, CJ, all us 80 IQs are mind blown right now. We're like, okay, I'm just so lucky that I hold Bitcoin. And really, you know, there has been a lot of macro talk recently, and it seems like Bitcoin is becoming even more macro involved. And, you know, there's the meme on Bitcoin Twitter, like macro, 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 everything's macro. People are getting upset about it, but it's becoming very obvious to anyone paying attention that Bitcoin is the solution. And hey, they are also looking for the solution. Anyone that sees the problem is looking for a solution. So of course, they're going to eventually end up at Bitcoin because we know all roads lead to Bitcoin. So here we are. I don't think I've heard a better storytelling narrative about the facts and what's going on, and just painting a picture that does seem very dark and bleak. Yet, if we didn't have Bitcoin,
then it would be bad.
Then it would be bad. 100%. Absolutely incredible, CJ. Well, really appreciate you coming on and educating our audience. In the meantime, we'll bring you on as many times as possible, guys. Let me know what you guys want. Send me questions. CJ, if they have questions for you, we can do a Q&A where we can cover everything from front to back. Anyway, absolutely. CJ, hang out in the back for a moment. Sweet. Hang out in the back for a moment while I wrap this up, and we'll talk about this. Guys, absolutely incredible rip today. Shouts out to CJ Constantinos on Twitter or X, on YouTube. I highly recommend you guys follow his Twitter because he lays this stuff out for you guys basically every single day. Yet me, I am a vocal, oral, visual learner. So, you know, I can read it and I'm like, yeah, this makes sense. But when someone explains it to you, it just hits that much harder. And we connected all the dots for you guys. So like, share, subscribe, send this to your normie friends, send this to your parents, send this to your macro financial advisor that's like, you're an idiot Bitcoiner. Because I don't think they're going to beat this analysis. Anyways, guys, peace out. We will be back tomorrow for our normal show. What a rip. What a rip. All right, peace out.